Whoa, did you catch that? Well, hey everyone, it's John Chapman, certified financial planner at WorthPoint Wealth Management, where I help investors secure their financial future. Have you looked at your brokerage accounts recently? And maybe you've been ignoring it because the first half of the year was painful. Many investors I know stopped looking at their brokerage accounts altogether. Even worse, some investors decided to sell out of the market in the first half of this year in hopes of avoiding future losses and thinking there's going to be a better time to get back into the market. Well, there's been a quick turnaround. In the past 2 months, the S&P 500 has recovered over 13%, and really a surprising and a quick fashion. And the point here is that even though we think the market goes down fast and goes up slowly, there can be times when the market recovers quickly. And missing out on that turnaround can be painful for our long-term performance. That's not to say that it's going to be rosy from here on out, because there still could be lots of volatility ahead, and no one knows. And granted, we are still down since January, with the market being down about 10% from where it started at the beginning of the year. But my fear is that investors, being paralyzed by the market, feel as if they have to take action when it gets volatile and sell out of the market completely. Risk is not destroyed, it's only transferred. In the same way that energy cannot be destroyed, it can only be transferred. If you have risk in a portfolio and you decide to get out of the market, it's not as if you're taking on no risk at all. You've merely transferred the risk of inflation, and the risk of knowing when and how to get back in. So instead of an all or nothing approach, you could consider simply sliding your risk profile down or readjusting your time frame and your goals. Looking at the big picture, reacting can hurt. As this chart shows, from 1990 to 2021, over a 30-year time period, investing $1,000 and being in the market over that entire time resulted in a 10% rate of return of $26,000 at the end, only investing $1,000. The same time period and just missing 15 of the best days resulted in a 7% return, only $9,000 over that time. A staggering difference, less than half, in only 2 weeks of the best days in the market, which likely occurred in the worst of times over this 30-year period. If you felt like you were losing sleep at the beginning of the year, instead of selling out of your portfolio altogether, it's important to go back to the drawing board on your financial plan. And if you feel as if your financial goals, your time horizon, or your risk tolerance has changed, one avenue to go down is simply reduce the risk in your portfolio rather than get out altogether, because the odds are in favor of long-term investors. At the end of the day, even if the stock market were to go down again from here, somebody that has their investments lined up to their goals, time horizon, and risk tolerance can continue to invest with confidence for the long term.